In the beginning, money was freedom. A folded note in your pocket meant independence, value you could carry, spend, or save beyond anyone's reach. But that freedom is quietly disappearing. Around the world, cash is vanishing not by accident, but by design. Governments call it modernization, banks call it innovation. But behind the slogans lies something deeper: control. For centuries, cash protected anonymity. Yet, in an age of surveillance and digital finance, every transaction tells a story: where you go, what you buy, even what you believe. What began as convenience has become a system of observation. The power once held in your hands now rests on a server you'll never see. This isn't paranoia, it's policy. Across continents, nations are phasing out large banknotes, capping withdrawals, and promoting cashless economies. In their place rises a new kind of money: programmable, traceable, and, ultimately, controllable. You'll be told it's safer, cleaner, more efficient. What you won't be told is that it changes the very nature of ownership itself, because when every dollar is digital, freedom becomes conditional. One switch can freeze your account. One algorithm can decide what you can spend. The war on cash doesn't use weapons, it uses systems, and most people won't realize it's happening until the silence is complete. Welcome to the silent war on cash. How? Governments plan to control your money. To understand the silent war on cash, we must return to the beginning, to a time when money was not yet an abstraction, but a thing you could touch, weigh, and trust. The earliest coins, struck from precious metals, bore no passwords or pins. Their worth came from their substance, and their authority from the seal impressed upon them by kings, emperors, and city-states. The coin was more than a tool of trade. It was a declaration of sovereignty. Whoever minted the money ruled the market and, in time, the people. The invention of coinage in ancient Lydia over 2.5 millennia ago was a quiet revolution. It freed commerce from barter and created something new: standardized trust. A gold stater or a silver drachma could pass from hand to hand across borders and generations, recognized by all. But behind the glittering metal lay something less visible: power. From the beginning, rulers learned that the ability to issue currency was inseparable from the ability to command obedience. Control the money, and you control the pulse of society itself. As civilization advanced, so did the manipulation of money. Rome famously clipped its coins to stretch imperial finances. Medieval kings debased silver to fund wars. Renaissance bankers invented the bill of exchange to move funds without moving gold. Each innovation expanded the reach of power, and each chipped away at the freedom of those who used the currency. What began as a practical convenience became a subtle form of control. By the 17th century, paper money emerged a new miracle and a new temptation. In China, the Song dynasty had already experimented with it centuries earlier. But in Europe, banknotes became a technology of empire. The Bank of England, founded in 1694, was born not out of generosity but necessity. The crown needed to finance war. In exchange for lending to the state, the bank received a monopoly on issuing notes. Thus, money creation became entwined with government debt, and the alliance between treasury and banker was forged. Paper money changed everything. No longer bound by the limits of metal reserves, states could expand the supply of money through promises rather than possessions. A note declared, "I promise to pay the bearer on demand." It was a promise backed by the authority of government and the faith of its citizens. But faith is fragile. Every monetary system is a mirror of belief. When confidence cracks, the reflection shatters. Still, for centuries, cash, whether in gold coins or paper notes, remained the citizen's last bastion of autonomy. You could trade without permission, save without surveillance, give without record. A coin or a note did not care who you were, what you believed, or where you came from. It was pure utility, untraceable, unjudging, and anonymous. Governments understood both the power and the peril of this freedom. On one hand, cash kept economies alive. It lubricated commerce, built markets, and underpinned confidence. On the other, it limited the state's reach. Taxes could be evaded, corruption concealed, transactions hidden from oversight. The very traits that made cash a tool of liberty also made it, in the eyes of rulers, a threat to order. The state's dream and dilemma was how to retain the benefits of money while eliminating its unpredictability. That dream began to take shape with the rise of central banking. What started as a mechanism to manage government debt evolved into an instrument of national control. By the early 20th century, every major power had a central bank empowered to regulate currency issuance, set interest rates, and act as the lender of last resort. Money was no longer a physical thing produced by many, but a managed system directed by a few. The transition from gold-backed currency to fiat money, money backed only by law and confidence, completed the transformation. When President Richard Nixon closed the gold window in 1971, ending the Bretton Woods system, the last tether between money and material substance was severed. From then on, value existed because authority said it did. The dollar, the pound, the yen, they floated not on metal, but on belief. And belief, history shows, can be engineered. Central banks could create or destroy liquidity at will. Inflation, once a consequence, became a policy tool. Interest rates could be manipulated to stimulate or restrain growth. Money creation became a language of governance, a way to shape behavior, fund ambition, and quietly. Meanwhile, the nature of money in everyday life was shifting. The 20th century's industrial revolutions gave birth to urbanization, wages, savings accounts, and the rise of the consumer. Banks multiplied, credit expanded. People no longer paid with silver or gold, but with slips of paper and signatures on ledgers. The economy became a web of trust, layered atop trust. Still, cash persisted, the tangible reminder that, for all the abstraction, money could still be held. But the groundwork for its erosion was being laid. With each technological advance, the telegraph, the payment card, the computer, the state, and its financial intermediaries gained new instruments of oversight. By the time electronic banking arrived in the 1970 seconds and 80 seconds, most money already existed only as numbers on screens. What had begun as a convenience, direct deposits, card payments, automated transfers, became the new normal. Each innovation carried an invisible cost, a trail of data. The state's interest in that data was not always sinister. In many cases, it was practical. Tracking money helped prevent crime, collect taxes, enforce sanctions, manage crises, but it also opened a door that could never again be closed. Once money became traceable, privacy became negotiable. Once transactions became data, data became power. The seeds of the silent war were planted here not in conspiracy, but in bureaucracy. As governments sought efficiency and banks sought profit, both found alignment in digitization. Fewer notes meant fewer costs, less risk, more control. The public, seduced by convenience, offered little resistance. The smartphone would later perfect the illusion. Infinite access, instant transfer, global reach at the cost of invisibility to oneself. By the dawn of the 21st century, the first phase of the war on cash had already been won without a shot fired. We still held notes, yes, but fewer, and less often. The infrastructure of digital money surrounded us. ATMs, online banking, point-of-sale networks, payment processors. Each link promised safety and speed. Yet each link also connected us more tightly to systems that could see, record, and regulate every move. It is tempting to view this merely as progress, but history whispers another truth. No instrument of power ever remains neutral for long. The same systems that promise protection can also enforce compliance. The same technologies that enable freedom can, in other hands, restrict it. This is where the story begins, with the slow, almost invisible shift from autonomy to administration. A world in which money once meant independence now begins to mean permission. The note in your hand still bears the state's seal, but the space to use it shrinks. The war is not declared, yet it unfolds silently, systematically, with the calm inevitability of policy. And like all wars waged in silence, its first victims do not even realize they are under attack. By the mid-20th century, the architecture of money had become inseparable from the architecture of the state. The aftermath of 2 world wars and a Great Depression had taught governments a painful lesson. Stability, growth, even national survival depended not on gold or silver, but on managing trust itself. The 1944 Bretton Woods Conference was the turning point. In a quiet New Hampshire resort, diplomats and economists built the foundation of the modern financial order. The U.S. dollar would anchor the world's currencies. Around that anchor, the International Monetary Fund and the World Bank were born institutions designed not only to rebuild war-torn economies, but to maintain global monetary discipline. In theory, it was a system of cooperation. In practice, it centralized power in the hands of those who could print the reserve currency. For the next 2 decades, the post-war boom hid the fragility of this arrangement. Factories roared, wages rose, and consumption became a civic virtue. Cash filled pockets, prosperity filled hearts. Yet, even as the world celebrated abundance, the scaffolding of control grew stronger. To manage the expanding economy, states relied on banks, and banks relied on central banks. The layers multiplied. A citizen's relationship to money, once direct and tactile, became mediated by institutions, screens, and signatures. In this new world, credit was the oxygen of progress. Mortgages built suburbs, auto loans filled highways, and installment plans filled living rooms with televisions and appliances. To buy now and pay later was not merely a convenience, it was a creed. Governments encouraged borrowing because it fueled production. Banks encouraged it because it fueled profit. And behind it all stood a silent arbiter, the central bank adjusting interest rates like a puppeteer adjusting strings. Cash still reigned in daily life, but the culture around it shifted. Plastic cards began to appear, first in elite hotels, then in ordinary wallets. What started as the Diners Club novelty in 1950 became, by the 1970 seconds, a global phenomenon. Each swipe replaced the exchange of notes with the approval of a machine, an invisible handshake between banks. The world was learning to live without the physical presence of money. And few noticed the trade-off. Every transaction left a trace. Governments noticed. The oil shocks of the 1970 seconds, rising inflation, and the breakdown of Bretton Woods exposed how volatile modern economies had become. In 1971, when Nixon ended the dollar's convertibility to gold, fiat money was no longer just policy, it was destiny. Currency was now pure confidence, sustained by faith in central banks and governments to manage it responsibly. Yet with this new freedom came temptation. Money creation no longer required gold. It required belief, and belief could be stretched. From that moment, the rise of digital systems accelerated. Banking networks interconnected across borders. Computers replaced ledgers. Data replaced paper. Governments and banks began collecting information at an unprecedented scale. The purpose, they said, was efficiency. To combat fraud, track economic trends, prevent tax evasion. But the effect was transformation. Money ceased to be private. The cashless society, once a futurist fantasy, was becoming a policy goal. The first battles in the Silent War began here, framed not as conflicts, but as improvements. Large denomination notes were quietly withdrawn under the banner of crime prevention. In the 1990 seconds and 2000s, countries from Canada to the EU began phasing out high-value bills like the $1,000 note or the 500 euros. Officials claimed such cash enabled money laundering and terrorism. But the effect was subtle and profound. Vast amounts of legitimate wealth were pushed into traceable systems. Privacy, once a default, became a suspicion. Technology deepened the shift. The spread of the internet and smartphones turned payment into software. What had once been a transaction between two people became a dialogue between devices, servers, and databases. And at each step, someone watched. Not maliciously, perhaps, but watched nonetheless. To the average person, these changes felt liberating. No more waiting in line to pay bills, no more counting change in dim light. The digital revolution democratized convenience. But to those who understood history, it signaled something older. The consolidation of monetary authority. For the first time in centuries, states had the technical means to see, analyze, and influence the financial behavior of their citizens in real time. What empires once attempted with armies and taxes, modern governments could achieve with algorithms and regulation. And so the silent war advanced not with force, but with persuasion. Each policy was framed as progress. Go cashless, the slogans said. It's faster, it's safer, it's modern. Retailers offered discounts for card payments, banks charged fees for cash handling, ATMs became fewer and farther between. The invisible boundaries tightened, but they looked like convenience. The frog, as the saying goes, never felt the water warming. By the early 21st century, entire economies were running on electrons. In Sweden, cash accounted for less than 1% of daily transactions. In South Korea, stores began refusing paper money. In India, the government shocked its population in 2016 by declaring 86% of banknotes invalid overnight, a demonetization campaign meant to fight corruption, but which plunged millions into chaos. For a few weeks, the world glimpsed what a sudden end to cash might look like. Long queues, lost savings, and lives disrupted. But the message was clear. The infrastructure to control money at the tap of a key now existed. And it worked. By then, the architecture of financial control was complete. Payment networks spanned continents. Data centers mirrored every transaction. Laws mandated reporting thresholds for even modest transfers. The modern citizen, unknowingly, stood at the intersection of history's oldest tension. Cash, anonymous, unrecorded, unpredictable, became an inconvenience in the eyes of both regulators and corporations. The rise of this system was not evil by design, but its logic was inexorable. To prevent crime, one must monitor. To stabilize markets, one must intervene. To ensure compliance, one must observe. Step by step, justification by justification, the sphere of privacy contracted. The war on cash did not begin with bans or proclamations. It began with habits, small, easy choices that made life smoother. But behind those habits stood institutions that had learned, over centuries, the lesson of empire. Power resides where money moves. And by the dawn of the digital age, nearly all money had stopped moving in the open air. It flowed instead through invisible pipes, regulated, logged, and if necessary, restricted. The rise of this new order was not loud nor bloody. It was elegant, efficient, inevitable, and it laid the foundation for what would come next. The age of programmable money and the tightening circle of control. Every empire of money begins in confidence and ends in control. By the dawn of the digital century, the infrastructure built to connect the world had also bound it. The same networks that moved trillions across continents could, with the flip of a switch, isolate an individual. It began, as it often does, with fear. The terrorist attacks of the 11th of September 2001 changed the moral vocabulary of finance. Governments realized that money was not only the bloodstream of commerce, but the lifeline of crime and terror. In the name of security, they tightened control. The USA Patriot Act and its global counterparts expanded financial oversight on an unprecedented scale. Banks were ordered to report suspicious activity, to flag unusual transfers, to know their customers more intimately than ever before. Privacy, once a right, became a risk factor. The digital tools that promised freedom now served as instruments of scrutiny. Every swipe, every transfer, every deposit created a traceable record. Algorithms replaced suspicion with certainty. The infrastructure that made spending effortless also made monitoring effortless. Ordinary people accepted it because it came wrapped in noble language: safety, transparency, anti-corruption. But behind that rhetoric, a new dynamic took shape, one where access to money was no longer a given, but a privilege extended under supervision. The 2008 global financial crisis exposed the rot beneath the system. Banks that had fueled the illusion of endless prosperity collapsed under their own recklessness. In response, governments intervened, printing money to save the institutions that had endangered the world. Trillions flowed into bailouts, while ordinary citizens watched their savings evaporate. A moral line was crossed. Risk was socialized, reward privatized. Money, once a shared language of value, had become a tool of hierarchy. Out of that disillusionment came a counter-movement. Bitcoin, born in 2009 with a single declaration coded into its first block, Chancellor on brink of second bailout for banks. It was both invention and protest, a digital currency designed to exist beyond the reach of states and central banks. For a brief moment, it seemed to resurrect the old dream of financial freedom, money without masters. But even this rebellion revealed the depth of dependence. Governments did not need to ban it outright. They simply surrounded it with rules, taxes, and surveillance. The architecture of control adapted faster than the architecture of escape. Meanwhile, the rhetoric of war on cash grew louder. Officials claimed physical money enabled tax evasion, terrorism, corruption. Economists argued that eliminating cash would allow for negative interest rates, a way to force spending in recessions. What had begun as a technical debate about efficiency became a moral crusade. To favor cash was to seem regressive. To question digitization was to invite suspicion. The social contract was rewritten quietly. Compliance became virtue. Privacy became deviance. In the shadows of these policies, deeper contradictions festered. Financial exclusion grew. Those without bank accounts, smartphones, or stable IDs were left behind. Every system built to prevent abuse also punished the powerless. In rural markets, in aging hands, in places where cash still meant survival, the disappearance of physical money was not modernization, it was erasure. The silent war had casualties, but they left no headlines. And yet, the public did not revolt. They adapted. They tapped phones, scanned QR codes, trusted that the light on the screen represented value. The corruption was not in a single act, but in the slow normalization of dependency. Every system that promised security also demanded surrender. The war on cash had ceased to be about money. It was about obedience. When governments realized they could freeze assets with a keystroke, whether of oligarchs, protesters, or ordinary citizens, a new kind of power emerged. The ability to punish not through prison or censorship, but through exclusion from the financial system itself. No need to seize property or issue decrees. Simply make money stop moving. That is the essence of the conflict. The instruments built for safety became tools of subtle coercion. The infrastructure of finance banks, payment processors, digital platforms became the quiet battlefield of control. And like all wars fought in silence, it did not look like tyranny. It looked like progress. No war remains silent forever. Control, once invisible, eventually reveals itself in crisis. The same systems that promise stability begin to show their price not in chaos, but in conformity. The collapse of cash is not an explosion. It is a quiet suffocation. One morning you wake up and realize your wallet has disappeared, replaced by an app. Your bank is your gatekeeper, your identity is your key, and the marketplace, once a place of free exchange, is now a monitored grid. The transformation began not with dictatorship, but with design. Central banks around the world, from China to Europe, from the U.S. to Nigeria, began experimenting with a new species of money, the central bank digital currency, or CBDC. Every unit exists within a digital ledger controlled by the issuer. Each transaction, time-stamped and traceable, flows through a network that never forgets. To its advocates, this is efficiency, the next logical step in a digital economy. The pitch is seductive: faster payments, fraud protection, inclusion for the unbanked. But beneath the rhetoric lies something older, the dream of perfect oversight. A CBDC allows governments to monitor every transaction in real time, to restrict spending by category or geography, even to impose expiration dates on money to stimulate consumption. In the wrong hands, such tools can rewrite the relationship between citizen and state. No need for force. Control is coded into the currency itself. The collapse of cash was accelerated by global shocks. Pandemics discouraged the touch of physical money. Inflation crises spurred digitization. Sanctions weaponized financial systems. When nations saw that they could freeze entire economies by excluding them from global networks, as happened with Russia in 2022, the lesson was clear. Control over payment rails is control over power itself. Money became an instrument of diplomacy, discipline, and war. Meanwhile, everyday citizens grew accustomed to the trade-off. In coffee shops and taxis, in donations and wages, cash became the exception. Value turned abstract. Intangible faith without form. But with abstraction came vulnerability. Power outages, cyber attacks, banking freezes all became existential threats to personal autonomy. When everything depends on systems you don't own, even a minor disruption feels like a revelation. Freedom was never yours, only borrowed. The collapse of cash reveals this truth in slow motion. What we lose is not paper, but privacy, not metal, but memory, the unrecorded transactions that once made us sovereign in our small choices. Yet every collapse births a transformation. As governments march toward digital control, new forms of resistance emerge. Decentralized cryptocurrencies, privacy-focused payment systems, and barter networks rise not as fads, but as symptoms, the system's immune response to overreach. They echo the old function of cash: autonomy, anonymity, human scale. But the state? The battlefield shifts from paper notes to digital protocols. The transformation also forces a moral reckoning. When we trade physical freedom for digital efficiency, we invite a future where dissent can be silenced with a software update. The currency of tomorrow may not simply reflect value, it may enforce behavior. Programmable money. Economists call it funds that can only be spent in approved ways, at approved times. It is not a dystopian fantasy. Pilot projects already exist. Still, collapse does not mean annihilation. It means revelation, the exposure of what was always there. The silent war on cash was never about banknotes. It was about the boundaries of trust, the balance between liberty and control. As the transformation accelerates, societies face a choice: to build systems that serve the citizen or systems that manage them. In the end, the fall of cash is not the end of money. It is the end of forgetting, the end of private space in the public economy. What replaces it will define the next century, just as the printing press and the central bank defined the last. The question is no longer if the transformation will happen, but who it will serve. The war on cash was never fought in the open, yet its victory is written in plain sight in every tap, swipe, and scan. The battlefields were not cities but systems, not soldiers but servers. And like all quiet conquests, it succeeded not through force, but through consent. We wanted what it offered: speed, convenience, safety. What we surrendered was invisible privacy, autonomy, and the power to exist unrecorded. The legacy of this transformation is paradoxical. On one hand, the digital economy has made life frictionless. Money moves across continents in seconds. Entire industries operate without borders. On the other, it has made human freedom more conditional than ever before. Every transaction now passes through layers of permission, surveillance, and policy. What was once a private exchange between individuals is now a public event stored, analyzed, and judged by unseen intermediaries. Governments assure us that oversight protects us from crime, from fraud, from collapse. But history whispers a warning that every system designed for safety eventually tempts its custodians to use it for control. Today, a government can freeze an account with a keystroke, or program a digital currency to expire, or restrict spending by category. The power once symbolized by the monarch's seal now resides in code, unaccountable, efficient, absolute. The moral cost is subtle but immense. When people know they are watched, they behave differently. When money itself becomes conditional, trust shifts from one another to the system. The economy no longer reflects human choice, but compliance. Yet, awareness is its own form of resistance. The story of money has always been a contest between freedom and control, between belief and power. Every generation must decide where it stands. Cash was never perfect. It enabled crime as easily as commerce, but it was human. It existed in the hand, not on the server. It carried no memory of where it had been, no judgment of where it would go. It was, in the truest sense, amoral and therefore free. The legacy of the silent war is not merely technological, it is philosophical. It asks whether a society that cannot transact privately can truly call itself free. The outcome is not predetermined. The architecture of control can be challenged through law, through design, through conscience. The future of money will reveal what we value most: efficiency or independence, safety or sovereignty. Because the story of money has never been about wealth alone. It is about the boundaries of power and the price we are willing to pay to cross them. When money loses its memory, humanity gains freedom. When it remembers everything, we live inside the memory of power. Thank you for watching this video. Click here to watch another video that might interest you.